Opening a brokerage app feels like stepping onto a high-stakes casino floor. Flashing red and green numbers create a constant digital pressure to act immediately. Speculating on a stock like it's a digital lottery ticket is the primary way millions of people lose their savings during market crashes. They chase price movements without any connection to what is being bought. Warren Buffett's approach changed at age 19 when he read Benjamin Graham's core definition of a stock. It is a legally binding, fractional ownership stake in a physical business. Wealth building looks very different when you treat a portfolio as a collection of brick-and-mortar companies rather than a gamified app. Imagine owning a local coffee shop. It's a boring operation, but it has steady customers and generates reliable profits every single month. Now imagine a business partner named Mr. Market. Every morning, he bursts through the front door, shouting out wildly different offers to buy you out. Monday, he offers $1 million. Tuesday, he's depressed and offers 50 grand. You would never sell a profitable physical business just because a moody partner is having a dramatic morning. You would wait for him to be sober and rational before discussing a price. Success in the stock market requires the same detachment. Smart investors use these emotional mood swings to their advantage, buying when the market panics and prices drop below real-world value. This chart shows the sharp V-shaped drop of March 2020. As global panic set in, market prices plummeted in a matter of days. During this crash, companies like Microsoft remained functional physical entities. They kept their employees, their offices, and their intellectual property. The market was simply having an emotional meltdown, putting world-class businesses on sale. Benjamin Graham taught that the market exists to serve the investor, not to instruct them. You win by understanding the underlying value of the business and only acting when the price makes mathematical sense. Even an excellent company is a poor investment if the entry price is too high. Because the economy is unpredictable, overpaying leaves you with no room for error. Graham solved this using an engineering principle called the margin of safety. Engineers don't build a bridge to hold exactly 10,000 pounds of traffic. They build it to withstand 30,000, allowing the structure to survive the unexpected. If you calculate a business is worth $50 a share, you wait to buy until the price hits $30. That $20 gap is your structural cushion. It protects your capital if your valuation is slightly off or the economy dips. During the 2008 financial crisis, pure fear caused a massive indiscriminate sell-off across the entire stock exchange. This panic allowed patient investors to buy shares of incredibly stable businesses like Johnson & Johnson at deep discounts. Their margin of safety was massive because the purchase price was so far below the company's real-world utility. An investor's true edge comes from the discipline to wait for a price that minimizes risk, regardless of how much a stock is currently trending. To navigate the market effectively, Benjamin Graham insisted on selecting a defined strategy based on your level of commitment, defensive or enterprising. The defensive path is designed for those who want to automate their wealth. You buy broad index funds like the S&P 500 every month and ignore the daily financial news cycle. The enterprising path treats investing as a disciplined second job. This requires digging through financial statements and earnings reports to find businesses the market has mispriced. Most people lose money because they try to play in the middle, casually guessing on individual stocks based on headlines without performing the rigorous research required for the enterprising path. When the market drops 5% in a single afternoon, the natural human impulse is to panic sell to stop the anxiety. Benjamin Graham observed that the dividing line between those who build wealth and those who lose it is simple emotional discipline. You survive the volatility by using automated systems like dollar-cost averaging that remove your feelings from the decision-making process. This is the same discipline a pilot uses when flying through turbulence. They don't yank the controls in a panic. They trust their instruments and stay on the predetermined flight plan. The stock market effectively transfers wealth from the impatient to the patient. Success comes to those who treat stocks like real businesses and maintain control over their own reactions while compounding does the work.